Right, I have 12 o'clock. It is January 12th, 2023. So please be aware if you're watching this back, some of the information may have changed based on timing. Welcome everyone to our session today with Ben McFarland on FEMA 2.0. Without further ado, I'd like to turn it over to our guest, Ben. Thank you for being with us today.
Absolutely. Thanks for having me. It's really good to be here. It's been a couple of years. I'm going to go ahead and bring my slides up if I can find. Here we go. Can you see my screen?
Yes,
slides?
we can.
Great. Thank you. So thanks again. I'm Ben McFarland. I work for the Hampton Roads Planning District Commission. I'm a senior planner there. I work mostly on coastal resources issues. And one of those is our flood protection, our resiliency area of focus. And one of the issues or the kind of the applications we've been doing over the last several years is to try to encourage people to get flood insurance. And that's through this program we call Get Flood Fluent. And so today I'm going to talk, a little bit about that program, just a little intro, and then I'll go into some background and some information on FEMA's Risk Rating 2.0 program, and then talk a little bit about an update to our flood insurance calculator tool that we have been working on, this update for the last year and a half or so. If there are any questions, if you have any questions, please feel free to jump in and ask. You don't feel like you have to wait till the end. But for now, I'll just go ahead and get started. So as mentioned before, we have a program that we do to try to encourage people to get flood insurance. It's called Get Flood Fluent. So the website, getfloodfluent.org, has a lot of materials there, some educational materials, but also some media materials we put together for our local government partners. But for you all with your clients, I think this would be a good resource for you to share with them so they can get a better understanding of kind of what flood risk is, what risks they might have, and what they can do about it as prospective home buyers or even home sellers. They're important to know some of this information. The goal of this program overall is to really educate people in Hampton Roads about flooding and about flood insurance, what it does, what it doesn't do. We want to debunk some myths and misunderstandings about flood insurance in particular. And then really the key thing here is to encourage people to really look into detail into getting flood insurance for their property, whether that's by using our tools online to kind of get an understanding of how much it might cost, or preferably to give people enough information that they want to go out and contact an insurance agent to get a quote. So for National Flood Insurance Program policies, all those that's handled by regular homeowners insurance companies. It's a service that they provide on behalf of FEMA. So it's the same person that they might contact to get a quote for homeowners insurance. But that's the end goal, is to get people to have a better understanding of what it costs, what the benefits might be, and to make a more informed decision about whether or not to get flood insurance for their property, or for for their homes, or for their personal belongings. So this is our website here. I'm not going to go through the website in detail, but if we encourage you to go check it out. We have some handouts and other materials that are on the website. We also have some physical copies of those as well. So if anybody would like to have things they could hand out to their clients, we'd be happy to provide some of those. But this is kind of where we are putting all of our information on for public consumption on flood risk and flood insurance. But today I want to talk about mostly about Risk Rating 2.0. So this is a big deal. So for those of you that have looked at flood insurance before, this is flood insurance. The National Flood Insurance Program has changed quite a bit over the last year and a half or so. FEMA has been working on what they call Risk Rating 2.0, Equity in Action, for a number of years, with the idea of updating the process that they use to calculate flood insurance rates, to go from the old rate, or the old methodology, which was really based on flood insurance rate map zones, so your A, your V, your X zones, to a methodology that is based more on the specific location and risk of individual properties. So what they're doing now, and this applies to every policy in that the National Flood Insurance Program has. So if you have a policy now, it's being calculated using this new methodology. The primary goal for FEMA in this And I can't say whether or not they're actually achieving this goal, but the primary goal is to actually come up with more equitable rates that are tied to the actual risk that that the rate or the person purchasing the policy actually has. So as for before, people your risk was or your rate was based on which wide area you were in, which could have quite a bit of range in terms of the actual risk. Now they're trying to focusing in on the specific location of individual properties. And so that's the idea. Are they getting there? That's to be determined. But I'm going to at least talk a little bit about what they're trying to do so that you might have some more information when your clients, if they have questions. So a few things that aren't changing. Congress sets or has set a cap on the how much a flood insurance or national flood insurance program policy can increase. The premium can increase from year to year. That's 18%. That's a lot. But when we're talking about this new risk rating 2.0, we're actually seeing forecasted increases that are quite a bit larger than that. So that 18% is actually coming in is being used right now quite a bit across the country. The new risk rating 2.0, we no longer use the flood insurance rate maps to actually determine what your premium is going to be. Firms are still used to determine who has to purchase a flood insurance policy. That's used. So if you're in these what they call the special flood hazard area, that's the A zone or the V zone, you would still be required as part of your mortgage to get flood insurance. But they're not being used as part of the rating methodology. So the somewhat subtle distinction there, but important. And then there are still some of these discounts that they have for premiums, whether it's a pre-firm structure, if it's newly mapped community or your property is newly mapped into the floodplain, there's a discount there. And then also for CRS. So that's the community rating system. Here in Hampton Roads, most of our communities actually are a part of that, particularly the ones that have the most flood risk. And so many of our residents here that get flood insurance through the NFIP are getting those discounts already. So that's going to stay in effect. And actually, now with the new system, they're eliminating what were the preferred risk policies. So if you're familiar with that term, that's where if you're outside of the special flood hazard area and you meet a few other qualifications, you were eligible for a very low or a relatively low flood insurance premium. But because of that, you were not eligible for the CRS discount in your community. Now everybody is because they got rid of the whole preferred risk policy thing in general. So that's kind of where things are. What this means is that, I mentioned before that 18% increase. What FEMA is, so they're conveying this idea like, you'll start here, on the left with what your current premium is. And then every year, potentially you will go up 18% every year until you get to what they call the full risk premium. And at that point, you would start to get that full CRS discount. Their communication on this is a little squirrely, but the general idea is that your CRS discount is baked in from your current policy, and then once you start seeing the increase, it may or may not show up, but it's still there because it's used to calculate what your legacy premium is that starts you on your glide path. So the communication has been kind of confusing on this from FEMA in some respects, but it's there. What does that mean for us here at Hampton Roads? These are some numbers that FEMA provided before the implementation of Risk Rating 2.0. They put out these numbers for the whole nation. So for us here, we were going to see approximately half of policyholders in Hampton Roads see a decrease. And then about a half see a small increase per year on the range of $0 to $10 per month. And then a smaller number that would be seeing a much more substantial increase. That's not necessarily been borne out. It's hard to tell because we don't actually get numbers on the amount that people are actually paying for their policies. But the anecdotal information that we're getting from around here and also from other regions that we are in touch with is that the increases are a little bit more substantial than what was initially predicted. It varies quite a bit across our regions. So I work for the Planning District Commission. We have all 17 jurisdictions from across Hampton Roads, everything from Williamsburg in James City County, Gloucester County up in the Northwest. We go all the way out to Southampton County as well, and then to Virginia Beach. So different risks in different communities. And so different, some communities are going to see different changes in terms of like how much people are paying for flood insurance. So you can see here, Poquoson, for example, or York County, where they have a much smaller on average number of policies that are going to see a decrease, more people paying more for flood insurance in those communities. Whereas in, say, Portsmouth or Suffolk, you'd see more people getting a decrease in their insurance premium. And that's just tied to the actual risk that FEMA is calculating for those areas. Basically, it looks like the more coastal you are, the closer you are to the coast, the more likely your premium is to go up, as opposed to if you are in a more inland community. So those were the previous two slides. Those were the predictions that FEMA had put out. These are the actual kind of numbers of national flood insurance policies and or program policies in force. So these are the actual policies that were in place before the implementation of Risk Rating 2.0. That's in the green. And then in the blue, those columns represent the numbers of policies in force from the end of August of just this past year. And basically across the board at Hampton Roads, no community sees an increase. There are a few where it's basically level, but in the communities with the largest numbers of policies, we're seeing substantial declines in the number of policies in force. And I don't have these numbers off at the ready, but for example, in Norfolk, it's a decrease of about 2,000 policies from before Risk Rating 2.0 to August of 2022. So a couple, I guess, disclaimers there. One is that we don't know exactly why that many policies were dropped. People drop flood insurance policies all the time for different reasons, whether it's affordability, whether it's they sell the house and the new owner doesn't want to renew the policy. They pay off their mortgage, they no longer have to have a policy, so they might want to save some money there. And we often see here in a lot of places where, if there hasn't been a major storm event, then people will think that their risk is less, and so they're more likely to get rid of their policy. So for whatever reason, though, there's been a substantial decrease in the number of policies in force in Hampton Roads. And considering that flood insurance is really the best way that people can kind of protect themselves and their property, or at least be ready if a flooding event happens. That's concerning from our perspective here at the PDC. And I think, obviously this is an individual decision for really anybody that's, when you're own a property or you're a renter or a business owner, you have to take that all the different, concerns you may have into account when making this kind of decision. But at the aggregate level, it's concerning from a community-wide kind of risk mitigation or preparedness perspective, in that we have so many people in Hampton Roads that are choosing to drop their flood insurance policies, which means that if there is a major event that occurs, that we'll be less able to, or less, less resilient, we'll be less able to bounce back readily. People will have to spend more money out of pocket to repair any flood damages. So, we've seen a pretty significant decrease. We are not the only community that is seeing this kind of impact from Risk Rating 2.0 nationwide. In that same kind of rough time frame, about 400,000 policies were dropped, which is almost 10% of the entire number of national flood insurance policies that were in effect before the implementation of Risk Rating 2.0. And as I mentioned, for here in Hampton Roads, about 9,000 total. So that's about 15% or so of what we had here before Risk Rating 2.0 were dropped. So yeah, that's a concern. FEMA has expressed that, that they want people to buy flood insurance, that they want more policies to be purchased. That's where we're coming from with having Get Flood Fluent, with doing our media buys and our educational campaigns to try to encourage people to get flood insurance. So now that we're having this impact, we're seeing flood insurance go down. That's not what we would like to see. But how do we fix that? That's a pretty complicated question. There are and continue to be, and will for the foreseeable future, continue to be concerns about things like affordability. We're seeing flood insurance rates go up in response to risk rating 2.0, and particularly in those areas where you don't have to get flood insurance, but your rate goes up quite a bit. And I'll get into the weeds of why that happens here in a moment. But that kind of sends, mixed messages, right? We want people to buy flood insurance, but now we're making it much more, expensive to do so. And, people respond to price incentives. It's the same thing as when buying housing. If the price of housing goes up, people are less likely to buy. They are less able to afford the housing. And the same thing applies to flood insurance. There are some concerns about just the disclosure of flood risk information. So you may be familiar, for example, with the state law that was recently passed, I think it was last year or the year before, that required repetitive loss properties, sellers to disclose whether they were repetitive loss or severe repetitive loss properties to buyers. And that's just one example of a state mandated disclosure requirement. But FEMA kind of makes it a bit challenging to actually get that information if you don't already own the property. There is a way to do that, and I'd be happy we can talk about that later as well if there's interest. But for the most part, there's no national requirement to disclose flood damages from previous events. And there are concerns right now about whether or not FEMA is actually, when people get a flood insurance quote, they see just what that quote's going to be for this current year. They may not be able to get information on what the full risk rate of a property will be. And so that's a concern. We want people to be able to make informed decisions about purchasing a home. And, if they're going to buy a home, presumably they're going to potentially be there for a number of years. If that flood insurance rate is going to go up substantially, over 5 or 10 years, that's something that they should be able to take into account, in deciding whether or not to make that purchase, right? Because if the flood insurance rate, goes from, $500 a year to $3,000 a year or $10,000 a year, depending on where they are, that's a pretty big hit. So, understanding kind of where, not just where the rate is right now, but where it is going to be once it gets to the end of that glide path, that's important. And that's something that's not really being readily communicated right now. There continue to be what we call just this disconnect between good, sound floodplain management at the local level, regulations on what you can do in the floodplain and kind of how you should build better and more resilient, and insurance rates. So right now, the risk kind of calculations that FEMA is doing are the primary driver, and there's really not a lot that localities can do to better manage their floodplain to lower those rates. So it decreases the incentive that localities have to actually do effective and sound floodplain management. And there are a number of concerns about transparency, and you see a little bit of this here in a moment when I get into our calculator tool. But some of the data that FEMA used and some of the analysis they used to actually generate this rating methodology uses proprietary data and information. So they contracted out a lot of this work to private companies. Some of that data is available, through public agencies like the U.S. Geological Survey or NOAA, and others it's private data, and that they will not share or cannot share. And so as a result, it's really hard, I think, for people, when they get a quote from the NFIP to really kind of understand exactly what is driving that rate. Where, what are the things that are making it more expensive? Are there, a few attributes, different factors? There are a number of different factors that go into calculating a flood insurance rate now with risk rating 2.0. So, it's hard to know, is there anything that you as a homeowner can do about it? Or is it just that property is in an area that's high risk and there's nothing you can do except pay the rate? So just a few kind of current status things on where we are. FEMA, or the authority for the National Flood Insurance Program, comes from Congress as part of the big kind of omnibus spending bill that was passed at the end of last year. The authority has been extended, which is good. That means that people can buy new policies, but it has only been extended through September 30th of this year, and so they'll have to fold that in to another spending bill or some other separate bill at some point. There are a number of policies that Congress has considered or that FEMA has provided to Congress and asked them to consider. So for example, some of these have to do with establishing, putting, FEMA or the National Flood Insurance Program on sounder financial ground. Some to do with things like risk analysis and communication. So disclosure of flooded risk information. There's a provision that FEMA is asking for that would provide a federal way of providing this information. Right now, FEMA is not allowed, or they consider flood insurance policies and that information to be personally identifiable information. So they're restricted from sharing that, but they want a kind of a carve out for this to be written into the next authorization. There's some discussion about having separate rates for coastal and inland locations, and that's been already done to some degree in risk rating 2.0, but they're wanting something that just goes a bit beyond what has actually been done in risk rating 2.0 so far. There is some discussion about means testing or having kind of a affordability assistance. So that's something that I think a lot of regions would like to see to encourage people with lower incomes to be able to afford flood insurance. On a slightly more kind of concerning note, there is a proposal to define what FEMA calls excessive loss properties. So we have repetitive loss, which are properties that have had a flood damage claim that over 2 or more over a 10-year period with the damages below a certain threshold. I want to say it's $5,000 or $10,000 total. And then you have what they call severe repetitive loss, which are when you have that, several losses and you exceed that threshold. FEMA, this idea of having excessive loss properties are those that, once they exceed a certain threshold, they would be ineligible to receive a policy under the National Flood Insurance Program. Doesn't mean they wouldn't be able to get private flood insurance, but it does mean that they would no longer be able to get that public flood insurance option. So that's something that we would want to watch out for, just to see kind of how that would work, what the details would be. There's some additional discussion about prohibiting new coverage from the NFIP. So basically get out of high risk areas or no longer insure commercial structures. So that's something, again, depending on how they identify flood or high risk areas, that we would want to watch out for here in Hampton Roads. And then on the kind of a bookkeeping note, this idea of allowing private insurance to count as continuous coverage. Right now, if you switch from NFIP to private insurance, that doesn't count. And so your rate would reset with the NFIP if you were to come back to that public insurance option. This would allow that to count as continuous, which means that your rates would kind of continue along the same path without getting the full risk rate when you would ever come back to the NFIP. So that's just a few of the things that are going on right now. There's a whole bunch. There's a report that FEMA has submitted to Congress, and I can share that with you all if you're interested. That goes into quite a bit more detail on all of these proposals. All right, so I'll take a quick second here. Any questions so far? If you have a question, feel free to unmute and ask. Otherwise, I'll give you a couple seconds, then I'll jump into the methodology here. Okay, so risk rating 2.0. This is again, it's the new methodology that FEMA is using to calculate flood insurance premiums. You can see here on these charts, or on the left, the primary inputs to the rating methodology were your zone. So A, X, B, whether it was a single family home, a other type of residential property, or a commercial or non-residential property, your foundation type. So whether it's a crawl space or a slab on grade or on piles, and then how high up you built. So those are the inputs that FEMA used. It was a very coarse way of determining risk. A lot of it was based on the area that you were in, and so you might be closer or further away from the source of flooding than your neighbor or your neighbor across the street. And so your risk was actually, potentially much less or much greater, but your rate would be very close if your house was pretty similar. Now what FEMA has done is they've taken a whole bunch of other data. They've taken some pretty sophisticated catastrophe modeling and flood risk modeling, and they've added in a number of additional rating variables to try to calculate an individual risk rating for each property that it takes into account many different types of flooding, not just the primary one, which is what was under the old type of methodology. Looks at things like the cost to rebuild. So that's an example there of that proprietary data that FEMA is using. So they have a database somewhere they're getting from some private firm that is going to tell them, what the cost to rebuild a specific structure would be. And that's data that they're not providing out there for us to be able to go in and use or to verify. And then, so this new methodology, much more complicated, much more involved. But again, the goal here is to calculate an individual rate and risk rate for an individual property. So a good way of thinking about this new methodology is that it bases your flood insurance premium on kind of three general attributes of your structure: where it's built, how it's built, and then what you're actually getting insurance coverage for. And so you can see here a number of the different factors that go in to each of these. Each of these bullet points here is just one of the factors that FEMA is applying to generate a new flood insurance premium rate. The biggest drivers are things like what state you're in. So FEMA has done, or they've contracted out some pretty hardcore modeling to see kind of where their exposure was and what the historic flood risk, was, how, different areas of the country were being impacted by flooding and different types of flooding. And so every state now has its own kind of set of base rates. And those range, they're, from very low to, I can get you the numbers, but let's just say it's very low, and Virginia's somewhere in the middle. We're not nearly as bad off as, say, Florida or Louisiana, but we're certainly not at the lowest end either. How high, the land is, where your property is a big one. Whether or not you are on a barrier island, that's not a huge issue for us. We don't have the same kind of, development patterns in coastal areas as some places like Florida or North Carolina or Texas, where there's been substantial amount of construction on barrier islands. But it's there, and we have a handful of those. And then the one I just want to highlight here is building replacement cost again. That's something where FEMA is estimating, if you have a more expensive property, even though your amount of insurance you can still get is capped at $250,000 for the building, the replacement cost is actually being used to kind of calculate how likely you are to suffer damage, how much it would be to actually replace it, or whether it's contents or provide fixes. So the more expensive your home, the higher the replacement cost, the higher your rate is going to be now, which is something that was not used at all before. So what are we doing about it? One of the things that we're trying to do is, as I said before, we're trying to provide information to people on kind of what flood insurance is, what people need to know. And I think one of the things that people like to know without having to go through the whole process is how much does it cost? We put together a calculator a number of years ago that used the old methodology. And then when FEMA is set up risk rating 2.0 last year, we took that calculator down because it was no longer accurate. And so we've been working ever since on updating the calculator to take into account this new methodology. Unfortunately, we can only use the data we have. And as I mentioned before, there are a handful of data sets and other inputs that are proprietary. And so we're having to use kind of proxy data sets or inputs from the user. So from a person that goes and uses this calculator to provide that information. And so I would say it's far more likely than not that when somebody uses this calculator, that it will not give them the same number they would get if they were to call their agent. But the goal is to get something pretty close so that people can get an idea of, on the order of magnitude of what flood insurance might cost them. And then they can use that to kind of, make a next step decision about whether or not to call an agent. But again, our main goal here is to encourage people to take that extra step. This is easy, takes a few minutes of somebody's time when they use this tool to get a number. But really, we want people to call their agent so that they can get an actual quote from the NFIP. So let's see. So this is the calculator that FEMA has provided. I am not going to go into detail on this, but these colors kind of correspond to, let's see if I can go back. So again, red, blue, and green here, where it's built, how it's constructed, and what's covered. These are those sections of the examples that FEMA has provided. And I can provide the link to this website. So if you are interested in this at the nitty-gritty level, to go in and explore this. But what we have done is taken this methodology, so this tool here, and the rating factor tables that they've also provided, and turned that into a calculator where we've done a lot of the geographic calculations. That's that top area of the chart here. We've done all those already, and we provide those. We have basically a large database of every address in Hampton Roads where those numbers are already pre-populated. And then when someone wants to use this calculator, they go in, they answer a number of questions to kind of fill in the rest of the information that's needed before they would get a flood insurance or an estimate of what their rate would be. And so I have I'll run through. This is live, so if you're interested in going to look at it, it's on our on Get Flood Fluent right now. If you go to that website, when you first go, there's what they call a hamburger button on the right side. That's those 3 lines. You click on that. You can say, how much does it cost? Click on that link there, and it'll take you to this landing site to start the process. You click that, I agree with the terms of conditions, and then you start to answer questions. So I think we've got 13 questions total. One of the things we've done with this is because the methodology is so different, we want to provide information in case people want to know why we're asking this particular question. So that's what this I button is, or this exclamation point here is for. On every question, we have an explanation of why we're asking it. In this case, so I've just typed in the address for our agency here, the PDC. So obviously this is a fictional example because I'm in a commercial building. We're going to pretend that it's a single family home just for illustrative purposes. But so that's, it starts off with the address. And then you talk about what it's being used for, how many floors, the type of foundation, first finished floor height. So this is what the, how high above ground your first floor is going to be. That's a main driver of flood insurance rates. So that's important to know. But we have some additional ways, if you don't know, you answer that. And there's another kind of set of questions that help give us an estimate of what it would be. Whether or not it's built prior to 1977, this has to do with when your community joined the National Flood Insurance Program. And at that point, the rules of development would change. So older structures may be built lower. Newer structures are held to higher standards. And then flood vents helps. Again, this is a modifier that FEMA uses to kind of just tweak the rate a little bit. Machinery and equipment, same thing. Are your washers and dryers, are they elevated? Do you have HVAC equipment at ground level, or is it up, in an attic, or is it otherwise elevated? This is this question here about the estimated replacement cost. Because we don't actually have that data, we're asking people to provide it. Same thing for the contents, so the structure and the contents. And then there are a set range of deductibles that FEMA has established for risk rating 2.0. And so you would click from the drop down to select which one you would like to use, and then whether or not it's a primary residence. And that, again, they have a different set of rates for primary residences than for non-primary. And then once you answer all those questions, you'd get to a page like this that would allow you to tweak the level of building coverage. It's between $0 and $250,000, and the same thing for contents between $0 and $100,000. That's the level of those are the statutory kind of maximums of coverage that the NFIP can provide. So you would get that number, and then you could go back in and change some of your answers, or you can start over. But again, the idea here is to give people an understanding, or at least an idea of what their rate might cost. And we are working on improving it. We're getting some input from folks that the numbers aren't quite matching up what they're getting from their policy. We know that's going to happen because of just the limitations of the tool that we have. But we're trying to get as close as possible, and we're trying to go in and do these fixes when we see them, to make sure that it's as useful as it possibly can be. So that's the topic today. Be happy to answer any questions you might have. And again, getfloodfluent.org. We have a number of materials on that website that you or your clients might find interesting. And if you have questions about any of this or any of the other work that we're doing related to resilience or flooding, or floodplain management, my email address is there, and be happy to answer any questions you might have. Thank you.